Yo, welcome to the Creative Real Estate Podcast. I'm your host, Rikki Jack. Let's get it. Hello and welcome to another episode of Creative Real Estate. I'm extremely excited to have you guys on the show today. Today, I've got a guest by the name of Yair Tilson, and he owns a financing firm called Pancho Finance. So we're going to be leaning in on him, finding out a little bit more about himself, his operation, the business that he's involved in, as well as getting a better understanding of where the debt markets are at today, given the corona crisis taking place around the world, and exactly how debt is, or maybe not exactly, but giving us a bit of insights into how debt is priced and why we're seeing pricing in the situation that it's in today. So without further ado, Yair, welcome to the podcast.
Thank you very much. I hear the crowds cheer.
I think we're going to have to get used to doing some sport like that in the near future, potentially.
As well as having your Purell next to you, right on that color.
Yeah, just making sure we're keeping it clean on the call.
Making sure you're clean on the call. Very important. Staying healthy. Yeah.
Oh, brilliant.
How you doing, Rikki? All right?
Yeah, I'm doing good. Thank you. Bit of adjusting taking place at the moment. I think the more information, the more we try to understand, the more we know no one really knows. So
but that is the story of life. So we continue.
That's true. Yeah. So we just push on and see where things are falling out. And it's been an interesting 3 weeks for us all, I think, in the real estate space. 4 weeks ago, everything was normal and operating in a certain manner, and you kind of just were dealing with it. And Corona was something you heard about, but it wasn't a big issue. And today we're in a totally different market environment. So everything's changing.
100%.
What about yourself?
Yeah, we're doing all right. Hunkered down here now for almost a month in the house with the kids and the fam. But it's good. I mean, thank God we're healthy, and that's really the most important aspect to all of this, of course. But yeah,
absolutely.
Well, I guess we'll jump right into it in a minute. But yeah, it's a battlefield outside, and whether this is going to be a long war or just a very large battle, I think that's what we're all trying to determine that now. But there's no question about it for the next, at least foreseeable couple of weeks. And again, we'll talk more now. This is unprecedented. That's for sure.
Yeah, I think if anyone could have called an event like this happening, there's something going on there. So this is certainly kind of those black swans that come in that no one predicts. Yeah. Everyone's been saying there's got to be a market correction. Something's got to happen at some point in time. We've been on the rise and up for some time period. But would anyone have predicted it happening like this?
Absolutely I would beg to differ. That's for sure.
I think what I was just going to ask is that maybe we could get into a little bit more about yourself, your firm, understanding what exactly you do, a little bit of background on us, as we've been doing deals together now for, I think it's almost 4 years. I think I first came across you ages ago when we had a shortage on equity, and you got that last minute call, which I think is probably the worst one to have, is like, hey, yeah, we need a little bit of help on money. We're coming short on our capital stack.
We wouldn't have it any other way. We wouldn't have it any other way.
And it's been a good relationship since then. I think we've both grown from strength to strength, and look forward to you just sharing a little bit more about your
absolutely.
firm.
Absolutely. Thank you. Thanks, Rick. And thanks for having me on. Our firm, Pancho Finance, as Rikki was mentioning, we specialize in structured finance for commercial real estate throughout the United States. We have a particular focus on two different aspects of the capital stack. The core functionality of the business is our debt arm, where we do senior and mezzanine financing. When it comes to senior financing, we do everything from ground up construction, light value add to heavier value add, income producing, refinancing, really promote the fact that we specialize in kind of tailored financing for whatever given project that may be. We work with just about a slew of the different lending options, which many of them are shut down temporarily. But in the perfect world, we work from everywhere from the CMBS market through Fannie, Freddie, HUD, of course. We work with many of the larger institutionals throughout the United States, as well as a large slew of private debt funds who do all kind of sorts of lending. We also have an equity component to the business, as Rikki was fair mentioning before, which is what we call our equity placement side. There, what we're doing is, it's complementary to the existing debt division, which is allowing us to transact on more deals by be able to bring that extra component of equity, which is always so needed, or almost always so needed on a given deal. And how that works is we've been fortunate enough to have about 150 plus what we call capital partners that span globally, majority of them, of course, in the United States, with a very nice sized group of guys out of Israel, South Africa, Australia, and select areas throughout Asia. And with the right deals, those capital comes in the form of preferred equity and or JV equity. It's for another time to get more into the specifics, but generally speaking, that's the idea.
Absolutely. Okay. And I think where we're able to complement one another so nicely is you happen to be in Tel Aviv, formerly in New York. I'm mainly out of Cape Town and back and forth between Atlanta and Cape Town, working with a few different clients and groups in specific niches. And I think our sort of niche that we've managed to carve out together is helping real estate professionals around the world be able to come into the United States, get a grasp on that market, a better understanding of sort of how the market works there in terms of debt, equity, in terms of the specific asset classes. And I think that's why our relationship's been so complementary over these last few years. Absolutely. So maybe you could elaborate a little bit on some of the transactions that you've done, some of the facilities maybe that you've created in the recent past, and then we can start getting more into the topic of where things are at today.
And I appreciate that. Yeah, right. I totally agree. And actually, just to piggyback your point, and it's a good segue into giving you kind of a specific example of some of the stuff we're really proud of. One of the reasons why I have the extra value of growing up in the United States, really understanding the culture, the local markets, physically being at the local markets and understanding what they are, but at the same time having the privilege to have, really immerse myself and live in a separate country. And Rikki, you've kind of done it in a reverse manner, but I think with more and more exposure to the United States, it becomes easier. Now, the biggest challenge with internationals, of course, is that you always have to tell a story. But when it comes to internationals, there's a particular story you have to tell. When I say international, I'm talking about internationally based companies, where the principals themselves are foreign nationals to the United States, and they are investing in U.S. property, either through a JV relationship with a local U.S. partner, which is kind of one exercise, or directly and buying real estate directly with no local partners or anything. They're just international. And what does that mean to, whether you're bringing debt capital to a given transaction like that, or you're bringing a JV equity partnership to the deal, those things are going to play a part and are going to be quite significant when working with international. So because of that, we've found a particular niche in being able to sort of understand not only the cultural side of things, but the very specifics and how money can move from one place to another, how it's framed, how you make banks comfortable, how you make equity partners comfortable, so on and so forth. So we had a particular example on the debt side that we were very proud of. This happened. It's an ongoing facility, but it officially was closed about 6 months ago. We've been fortunate enough to have a tremendous client based out of Tel Aviv. They're actually now ranked, I think, top 30 now of largest industrial owners in the United States, with about about 15 million square feet of industrial property. The CEO is a tremendous young dynamic guy, a good friend of mine, and he's built up a tremendous company. They're on their 9th fund, and the real estate portfolio basically is amassed to about a $500 million portfolio currently, and they're in tremendous buying mode. Their 9th fund that they raised.
But this is a group that prior to meeting you had not really done much in the States as far as real estate was concerned.
Correct, at the very, very beginning. So that from the time this transaction closed, take about a 4-year step back, and it was a development over time. And Rikki, that's also a great point, because I think it's so important to understand context. And business is all about context. And we'll talk about it soon, how Corona's played effect. But, where we were in this very bull market the last couple of years, debt, equity, real estate as a whole had become such a commodity that people stopped, forgetting things, meaning I am buying real estate for the first time and my rate should be the same as what I saw in the paper that a guy's getting 3.5%, for example. Or I want an equity structure where I'm asking for an equity partner. I don't have a real track record. Why is that guy getting an 80-20 deal and I'm getting 50-50 deal, or whatever that may be?
Absolutely, yeah. And for anyone that's not tracking that, Yair is just referring to the sponsors promote. So essentially their profit share in the deal. So when he says a 50-50 split or an 80-20 split, is merely just referring to the operator's profit share.
So back to the story of what the deal was. Ultimately, this group had after building up a really sizable portfolio, and what happened is that they were buying. We got about 18 months ago, they started to get to a point, once they launched this newest 9th equity fund, which is $100 million. It actually ends up being $150 million all cash equity fund. So they were buying about several deals a month. And even when we had certain, anchor lenders, if you will, that were doing a bunch of our volume, the speed of efficiency and every time having to go, and because they were buying at such a pace, we needed to come up with a better solution. So first, we made them about 12 months prior to the story I'm telling you now, we got in their first miniature facility, which at that time was a $30 million credit facility. We can have a whole nother podcast about just what credit facilities and how they're set up. They're very complex, a lot of layers, but essentially, right, it's an idea where you're defining your loan box from the get-go. The borrower and the bank are going to an agreement, a future funded agreement, which says that as long as your property type fits this general box, we will lend at this general lending terms. And basically, once that facility is set up, it's a, you get a 24-hour response back as far as, yes, this deal will move forward with the facility. And then it's about, as long as it takes for the third parties to come back, it could be as quick as 14 to 20-day closings for these larger, you can do multiple closings at the same time. And there's all the other caveats to the facility, but we started with that. We then graduated to a $200 million facility with one of our lead national lenders. And thank God for this client. Then he locked in I'll give you some specifics on the $200 million facility. These are 3-year terms with 1+1 extension options. Because of their fund regulations, they can't be more than 65% LTV. So the fund is at a 65 LTV basis on every draw. And their pricing is at, I think we ended up locking it at 335 fixed. Yeah. Full IO during the whole loan period. So we locked that probably about 6 months ago, that rate. And then ever since then they've drawn. Just to understand the speed of this client, of that $200 million facility, they've already drawn in 6 months on $98 million of debt at 65%. So they're on a freaking tear. And I think Corona will only hands. I mean, we'll talk about it in a second. Obviously, they're dealing with just like any other property owners during this period of time, putting things to the sideline a little bit, just really analyzing their properties. But I don't want to jump. That's an example of something we're really proud of, and really break the layer of understanding international client, understanding what their business strategy is to best find a solution, and then ultimately finding a kick-ass solution.
Yeah, absolutely. And I think there's a great story there in terms of timelines, in terms of expectations, in terms of dealing with people trying to break into that market. Things do take time. You've got to be a little patient initially, but it's a snowball effect, and then it just takes off like crazy. I think you've witnessed that through that client. We've both witnessed that through a mutual clients and group that we worked with before, as Infinity. They started off pretty smaller and scaled up really quickly over a fairly short period of time. So I'd encourage anyone wanting to break into the market, wanting to get started, to just start with that first deal, to be patient. You might come from another environment that is where you're extremely recognized in that market, where everyone knows who you are and you've got a big track record, and it's easy to get financing, whether that's debt or equity. But you put yourself in the States and suddenly you're a really small fish in a giant ocean.
And we've dealt with those clients who
develop that track record.
Who don't realize that nuance exactly, because they were a big fish somewhere, and then they go into a bigger pond and it gets confusing. Yeah. That's that kind of setting expectations what we were speaking to earlier. And that's something really having to understand personalities, and what we've been able to work very well on, and being able to bridge those kind of mental challenges, if you will, exercises.
Absolutely.
So yeah, that's great.
Absolutely. Yeah. And that doesn't say that we can't work with any locals. I mean, you do tons of business with US-based clients on your side and both on my side as well. I think it just gives us a little bit of a niche for those that are foreigners wanting to get into that market, given that we've had a lot of experience in that environment. But if you're perhaps someone based in the States that wants to get involved, we can certainly assist you on both of those fronts too. So I think with that, I'm going to kind of put a line in the sand there. Let's get onto the hot topic everyone's talking about. The more certainty we're looking for, the more uncertain things become. But I think based on the information we have right now, there are certain parameters, at least within which we can work. And I think let's move on to the topic of the coronavirus, what it's been doing in the debt markets, and exactly what you've seen play out over there.
COVID-19. So that, I think what makes this topic so challenging is it's such a large topic. And what I mean by that is, even when we want to have a very direct conversation about real estate now and how it's impacting it, it's impossible to have that conversation without analyzing also the greater effect of what COVID-19 is. Because it's not a real estate issue, but it's very quickly becoming real estate challenge. So just to take one step back without fear of being CNN and going over the whole thing, all the rhetoric that we're all hearing, I'm just going to give you my feedback on what I've been speaking to top officials in the real estate industry who are having, daily conversations with the White House, and other chief economists that I've been either following closely and or having, direct conversations with. And essentially, it's important, again, I guess the word of the day could be context. Everything is context, and it's important to put things in current context. There is, now Monday, April 6th. There is 3 weeks from now, and then there is, whatever you want to call it, the new normal, the recovery, that period, that upswing, and when that happens. And that context is so crucial to the topic because, again, it's such a large topic and it affects us in such a systemic way that it's impossible to really look at it all in one conversation. And anybody who's trying to, and that's what makes, by the way, the news so challenging, because they're constantly trying to put it in a, let me explain to you what's going on context, and they're jumping too many thoughts in one. So there's just fear mongering, because the truth is, it is scary. It's scary right now. It might be scary for a couple of weeks, but it won't be scary in a couple months from now per se, but that will be a new normal. So I think it's important. The rest of what I will say sort of falls under that kind of understanding, and to kind of take it to there, where we are right now is currently COVID-19 is unprecedented, right? It's affecting us in a global way. Like we were just talking about earlier before we got on this call, Rikki. I'm in Tel Aviv. I've been experiencing this for 1 month now, just about the same experience you are now going through, which has been a little over, a week now. Whereas my colleagues in New York, our family in New York, have been going it for 3 weeks. Now people in Louisiana will be going it starting, the next first 5 days of it. Chicago's
everyone's at different points in the cycle.
China, nobody knows what's going on. It doesn't matter really at this point. All we know is it's come from there. That's what we know from there. So, everybody in its own way. It's hard to totally read what's going on in the Middle East with a lot of the Arab countries. They don't, also there, the news outlets are challenging. But the reality is that aspect is a major part of all this. And we'll roll into real estate. We'll talk about it in a bit, because the way that it's affecting, and now the world is very global. There is a lot of localized events. We, as for our conversation, we have to look at real estate in a global context, right? Because besides the fact that me and you, let's say, our homes, if you will, are outside of the place that we work. So there's a travel aspect, a human aspect, which we'll talk about in a second. What makes Corona so, heavy of that human aspect, as well as then there's the business sense, the capital that we work with, the people. I was just working with another colleague in South Africa solid company. Unfortunately, we had a term sheet, even actually produced for them during Corona already breaking out, which we were very impressed with. He was going to sign it, and now him and the seller came to an understanding that they're not going to do anything for 60 days. So those aspects, so even if it opens up in America and it hasn't in South Africa yet, that's going to affect things. So it's very important to see it. And in America itself, it's even more important, because all the attention's on New York. New York is a tremendous thing what's happening over there. But it's not there's going to be other hot zones, now they're calling it, throughout the United States that this is going to happen to, and it's going to happen in a cycle. So seeing all those things play out are, again, it's not real estate related, but it very much is, because those are the aspects that are going to also affect how this recovery cycle happens. And I'll speak to it. I'll speak to it in a second.
Just speaking to a global aspect over there, I know in South Africa at the moment, the countries like ours that have been under strain for some time prior to this epidemic even breaking out are under serious threat at this point in time. And it does play to a global aspect and an element in the States also, because I've got equity investors based out of South Africa over here too, that at this point in time just kind of everything's on hold. They've got real estate over here in South Africa. They don't know what's going to happen with that. They don't know in terms of tenants are trying to back out. They've even got blue chip listed tenants that are now trying to follow suit and saying, guys, we're going to pay our staff suddenly before we're going to pay our rent. And yeah, exactly that. So everyone's trying to play that same card, and no one really knows. And so capital, which would sometimes flow into the United States, is currently not flowing.
No, there's even capital issues. And by the way, Rikki, these topics are so large, but like the same issue that South Africa is having in its one way, in its own capacity, where it's very material supplies, things like that, which is really the larger of the fear in the United States, although that part of it is a challenge, and it's actually scaring people so much of how much of it is a challenge that they thought it would be to get supplies and materials as fast as they're getting. But everyone has the confidence that will come. They're throwing a lot of money, but they have a reverse issue. They financially necessarily weren't in position to just produce $6 trillion like they did. So everyone, as they say, more money, more problems. Exactly, everyone has their own, it's all relative in as far as what are issues, and they're all cosmic in their own way. So I think, that's again another podcast.
Yeah.
It's very interesting to know. So I wanted to kind of just to progress, get closer to the whole real estate side of things. Economists for the White House that we were listening to last week, they made a great point. And what they said is that this recovery is going to be very different than any other for two main reasons. One is this is a humane crisis. It's not a financial crisis, meaning that it's not that liquidity has all of a sudden disappeared from the marketplace. It is that the human beings, our systems, have been now either slowed or shut down temporarily, which is causing so you have one aspect of the physical that it's actually being shut down. And then you also have the other aspect that even though if people are sitting on capital, it's a mental thing. Why? How could I, all investing in, and for lenders, whether you're lending money or investing money to make a return, in all aspects, it's all about mitigated risk. That's how anyone determines some sort of return. That is the fundamentals to business. And right now, and again, when we talked about there's a couple weeks from now in the future, right now, there is zero barometer, if you will, for what is a level of risk because we have no idea what the world is. And that is what's making capital essentially also shut down, even though physically it's not necessarily like 2008 where capital has disappeared overnight. But the recovery is going to look different, similar to what I was saying, because of the emotional side. People are not, even if you open up things tomorrow, people are not just going to invest money because they don't know what tomorrow looks like. I have to understand, how am I mitigating risk? Am I going to be making money the same way in the next couple of months? Am I not going to? Until that starts to become more normalized, as well as understand what this disease we just went through. Are there vaccines for it? Can this happen again? All of these fundamental things that are so important, we are not going to be able to move on and start investing properly like you would where you see sharks, circling the bloody waters in a financial crisis. And literally at this point in time in 2008, people were buying up like crazy from all the crash. You're talking about 10 days Lehman Brothers crashes. It was dramatic. 10 days, 15 later, you had Occupy Wall Street and all that shit going on. That was more of the political side. But from a buying side, people were swimming and eating what they wanted. Yeah. Now you a totally radically different approach. And that's because that same investment banker is sitting in his house with his kids crying in the background. And his wife is nervous as heck. And the news doesn't talking about things. And he can't operate until then. He can take a call from a client, but he's not going to be making any investment decisions. So that's one aspect. And two, the manufacturer forbearance that is, no one could have dreamed that the financial markets would come out with such a radical, and the only reason they can is because the federal governments are backing them with these what they're calling stimulus packages. Now, the idea that you can manufacture basically a 90-day forbearance period, and we're in the United States, just to start getting closer into the real estate conversation, the United States right now, you're talking about 80% of lenders, both private and public, institutional, have now committed to basically a 90-day forbearance period, whether that's on private loans, real estate loans, etc. You have a couple of bad apples that are going to make it a challenge. But you have the general consensus, especially the major players, have given 90 days. This 90-day forbearance period, which again, we can talk hours about how it's structured and how that's going to affect the recovery. But essentially, it is giving a manufacturer 90-day period where you can't just fish. That same owner is going to hold on a little. He's going, hey, I know I'm failing my property, but the world's in chaos. This bank is offering me 90 days. I'm not just going to take a guy who's offering me 10 cents on the dollar for my property. I'm going to wait this out a little. Because why not? There's no reason not to. So
that's an interesting point. So what you're suggesting there is that there's a way more likely a situation where people are going to just hold out and try to pull it together. Whereas before, if it was called a 2008 crisis, banks, lenders would just be like dropping the arm. It would be a foreclosure. And someone would be ready to try to pick it up thereafter, but because of the situation, because of the humanity problem, as you call it, as opposed to a financial problem, all the lenders, the government, everyone's kind of stepped up to say, hey, here's a forbearance period. We're going to try to do our best to not have this situation happen. But I'm sure, nevertheless, there's still going to be a drop off, but it's going to assist it to an extent. And I suppose it's less of a culling, if you will.
In that kind of vein, in that conversation, to just sort of give you and you want just for your viewers, you want a more very now April 6th, update on specific loan, actual, or just the general sense of the marketplace? What do you prefer for this call?
So I think what I wanted to understand, I mean, terms are changing on a daily basis at the moment, so it's really difficult to say, but I think maybe if we could give a general understanding of where terms have gone. So for example, interest reserves, what differences are being made there? So when you're doing underwriting, what should I be considering when I'm looking at a deal and doing a due diligence? And then maybe just touching a little bit more on understanding how markets are priced. So me not living through a prior recession or working through a prior recessionary period like this, I see treasury rates falling. In my mind, I'm thinking all-in rates are going to drop. But what happens in reality? All-in rates go up. Why did they go up? Maybe we can just chat on those things. But let's start off with that actually, and then go across after just discussing how the debt is being priced. Let's move from that across into where terms are today, something practical things that we should consider as operators, syndicators, potential investors in our underwriting going forward.
That's you nailed it right on the nose. I mean, that's the classic misunderstanding. There's always, for years, I've always been talking about the disparity between the understanding of what the borrower and the conversation the lender is having, and that constant misunderstanding. And that's why we have a job, right? So the misunderstanding is exactly what you're saying. The Treasury has an impact, of course, on all-in rates. Let's call them all-in coupons for the sake of this conversation, what the borrower receives. Of course, there's some level of impact, but what the all-in coupon is made up of two variables, right? You have your what they call spreads, which is what is manufactured by whatever that lender is, whether they're private lender, Fannie or Freddie, CMBS. They come up with their own what they call spread, an investor spread, plus the indicator. That indicator could be Treasury, it can be swap, it can be LIBOR. LIBOR looks like it might be obsolete. It could be prime, a few other things. And depending on what the loan is, it would be spread plus whatever that index is. Let's take the 10-year Treasury, which is one of the more common used variables, would give you your all-in coupon rate. Not to get into too great detail, but essentially, as you can imagine, investor spreads are investor spreads. Just like we're investor, when there's uncertainty, etc., they're always going to go a little higher. Now, especially at the end of the day, the lender is aware of this variables, of this equation, if you will, just like we were mentioning. This is no secret. So as they're saying, the lender can only lend at such a dollar amount, okay? There's no game where there's a world where, the Treasuries, the spread was one place and the Treasuries dropped so low, so now rates are 1%. It will never happen. Now, what does happen is the Treasury, just like the stock market, is changing every single day. Spreads take time to readjust. They can take sometimes a couple of weeks to readjust. And what you did see for a very small period of time was during the bull market, because Treasuries were going higher and higher, you needed spreads to keep getting offset because there was a huge wanting to make money and there was so much money in the market. And the only way to be competitive was to bring spreads down, even though Treasuries were getting higher and higher. So what happened was, because of this cosmic shift of Corona and how quickly it happened, it was crazy, spreads didn't have time to adjust. So the Treasury and the Fed, by the way, who it really gets the biggest applaud through this whole thing. Whether or not they're able to print the money they are, that's a whole nother discussion, like we said earlier. But the reality is how they're stepping up and learning from 2008 and learning from things like TARP and now bringing into the stimulus package and all these things. It's really helped keep America on its footing and will ultimately have helped save the real estate market from absolute, devastation that it could have experienced. But either way, as Treasury started to predict this happening, and Rikki, did I lose you? As Treasury started to come down at speed they were coming, I'm talking about overnight losing a full basis point, spread started to readjust. So there was this period of like 3 to 4 weeks where, and that even less, it was more like 10 days to 2.5 weeks where you could have got these crazy bonker 2.5% fixed rate deals because spreads were still low. Since then, and over the last 3 to 4 weeks, and just to give you an update of where we are, a good segue, what we are seeing is in the Fannie and Freddie and HUD world, which is all government backed. So it coexists well with what's going on with so much government involvement. And they've really been the backbone institutionals that have been kind of saving grace, guiding light, if you will, through this entire period. Are they way slower? Absolutely. Have they changed a bunch of regulations to their normal terms? Absolutely. Have they pushed out closing dates? Of course. But they've been able to regulate rates. They've been able to give an overall clear messaging, coming out with good updates. And there is some level of business as usual where we've been fortunate to sign up some deals in the last 2 weeks with all of the crazy of Corona. And hopefully we'll be funding some deals in the near future.
Yeah.
So that, and where you're going to see all in coupons today for Fannie and Freddie, again, like you said, Rikki, they are adjusting every single day. No question, the market has not been this volatile since 2008, and probably even maybe more so in some ways. For those who don't know, the 80% of the market. Okay, so Rikki, let me now just give you kind of a understanding landscape of what we're dealing with over the next couple of weeks, and then hopefully we'll be in a bit.
Yeah.
So the financing market is in shambles. I mean, not to sugarcoat the situation, it's important for clients to know we all have big boy pants. We're all sitting at home. We know that the situation is pretty harsh out. So it's not so difficult to understand.
Yeah.
The same lenders are also sitting at home. Just about everybody is staying.
Something's changed.
I can tell you endless amount of stories, endless, of what happened over the last couple of weeks, and how I'll speak to a lender on Monday, waiting for a quote. On Tuesday, he tells me they're not lending for 90 days. Unfortunately, on Friday, some of the last, what I call pre-corona days, deals that were signed up, we thought at least those would get funded because there'd be a priority there. Ultimately, it seems that just about all of them, about 90% of those deals will ultimately now be pushed at the very best till May. And these were all deals that were supposed to close in March. So, and what's happening is that you have large areas of the marketplace like CMBS, which can total, let's say, in any given year, over 40% easily, if not higher, probably close to 50% of all loans are being done through the CMBS market. It's shut down, right? So all lenders, whether they're as big as Deutsche, Chase Bank, Bank of America, any of these players who have these CMBS programs, they will not quote you at all. They may entertain deals and they will maybe say, we are interested and we want to work on it, but there'll be no real commitments for 60 to 90 days in that case right now, which is extreme beyond. Again, not to overstate it, we all know we're in a tough situation, but that's pretty dramatic. As I said, Fannie, Freddie, HUD have been staying consistent for the most part. Banks are just one by one closing the doors. They've been the slowest to do so. They gave a lot of confidence at the very beginning. Now, the reason the banks gave the confidence from the beginning is because, again, this is, and I'll say it over and over again, this is not a 2008 financial crisis. There is technically liquidity, right, in these banks. Now, if Corona continues to go longer than even predicted, then obviously everything will continue to get more and more corroded, and liquidity will have a way of losing, right? If everyone goes to the bank and asks for their money back, the bank's not going to have any liquidity, right? So they're keeping things calm. However, over the last couple of days even, New York specifically, financial capital of the world, you have just about everyone from Chase Bank to Carney Bank to regional, locals, large ones who are been, besides maybe some business loans and a lot of these forbearance things and all of this stuff that's keeping them busy, issuing new commercial real estate loans, even for refinancing, is basically becoming non-existent. Again, hopefully for another couple of weeks. I can tell you I was supposed to have a refinance funded already. It was getting delayed because of Corona. Appraisals were taking a little longer. We were supposed to get credit committee on Friday. Instead, he came out of credit committee to tell us that, please tell your client, we want to do this loan. We're going to do it at the terms we allotted, but we can't give any commitment until May 1st.
Wow. So most of them are just waiting on rental collections.
Rental collections. They want to see how the government, I mean, we all know the rental collections are going to be terrible. What we're waiting to see is what the government essentially did is they created this circle. And the circle is where they are telling the renter that, don't worry, we're going to have programs to give you money to pay your rent. They're telling the landowner, don't worry, we're giving you abilities that the bank is going to give you forbearance so that you won't have an issue. And then the government's telling the banks, don't worry, if you're giving everyone forbearance, we're going to give you a stimulus to keep you going. And this is sort of this, it's working to some sort of extent, but again, waiting more information.
Everyone's waiting on more information.
Exactly. And then also
exactly what happens.
Right. And also,
how does it practically play out?
Exactly.
Someone's got to run all the stimulus packages. You can't just throw
that's
billions of dollars into the economy and expect it to flow. So how does it flow? Under what principles and guidelines? What are the consequences of picking up the forbearance? And then you got to repay it.
And again, what should things really be priced at?
They're already struggling.
With all this uncertainty, that is not going to call for a very cheap dollar amount if someone's going to give you a dollar in an environment like this. And I'll tell you lastly.
How long do you discount your low cash flow for? You know, it's like if you're working off a simple DCF and you're trying to price something from an investment return perspective, and you're like, well, is it going to be 12 months of no income? Or is it going to be 6 months? Or is it going to be 2 years?
That's right.
And then things normalize.
I'll tell you one last thing, and not to get too, it's a little more philosophical now. I'm not going to get into it, but also banks are smart, right? They understand all they do is mitigate risk all day long. And they're no dummies to understand that the current would end up being advertised as 2, but really a 3, but actually a $6 trillion all-in stimulus package the United States is doing, that only keeps, if you think of the United States as a company, which essentially it is, that only gives you 45 days of operational money. Okay, and if they had to do it in this way, meaning the 6 trillion is based on the idea that in 45 days from now, it would stimulate it in a way that it could start producing for itself again, and then you wouldn't have to do the same level of stimulus. But if in theory,
is that based off
that's based off just where all the money is going
days?
And what is it going towards. So meaning it taking a large portion of that money that was given to private individuals on the basis that they'll be out of jobs for only 30 to 45 days. If they're now out of job for 60 to 90 to whatever that may be, 180 days, then are you going to be doing the same act each 45 days, giving the same money, and so on and so forth? Again, all the money that went towards that's just a kind of give an example. So, and then where we're seeing, and I don't really want to get into too much, it's a larger conversation. Obviously, investor appetite in one word is either you're completely screwed on a deal and you have to figure out new capital sources right now. That's why you're looking for capital on a deal right now, whether it was Corona or not Corona. If you're under contract and you just found the worst seller in the world who for some reason Corona is not affecting him and he just can't understand you, and force majeure is not, exactly. Force majeure is just not possible, and you're working through it, and you need a solution. You need an equity partner or whatever that may be, and maybe just maybe a straightforward recap or something like that. That's all you're seeing as far as even there's almost zero trading going on right now. Which is also so dramatic, right? Just zero trading. CB Newmark, some of the largest, investment sales houses on recent webinars, they've been promoting the fact that at this point, 80% of all deals that are under contract pre-corona have either fallen out of contract or have now been delayed, for 60 to 90 days. It's number's probably higher.
Yeah, I think all the new sales have not pulled out, but they're holding back on. So there's no new stock.
You'll get your inbox nailed by some junk regurgitating existing deals in the market. Because what is an investment sales broker supposed to do? Just sit at home? I mean, he lives and dies by So he's just going to promote things, but there's nothing happening. And besides the fact that, like I was saying, it's going to be very difficult to even get funding per se, even from a senior level. So
I'm conscious of time here. So just to wrap it up, from a practical perspective, I'm looking at getting a loan. CMBS is off the table right now. Agency's an option. Sounds like bank financing is still an option. I've seen some pretty competitive bank financing terms, but they're well in there with the recourse. There's not many competitive that are non-recourse. So as far as that's concerned, it's always something to think about. And I guess we could do a whole separate topic on this, but let's maybe just talk specific to bank financing and agency, what we're seeing over there in terms of loan to value, rough guideline on interest rates. And then, so I think more importantly, and what people maybe don't consider as much is in terms of the reserve requirements, what that's looking like. I mean, I modeled some of the reserve requirements into some of the underwriting that we've done pre-corona to post, and it throws off returns by like at least 1% to 2% as an IRR. So just having to raise that additional equity, hopefully you never need to use it. You can get it back. There's some provisions in there for that, but practically speaking, you've still got to raise it on the front end, and that just affects the deal altogether. So maybe you can just talk on some of the brief highlights. And I understand it's not.
So just for the viewers and whoever would be listening, from April, let's call it till end of April. Right now, everyone's using April 30th as a date. It's a frivolous date. All it is tied to President Trump saying that he plans to reopen the economy, reopen everything by that date, which is a decent amount of time between now and then. I don't know for you, but the last 30 days felt pretty. We'll see how this next 30 days feels, or whatever it is, plus or minus. But assuming that it's perfect and reopens by April 30th, between now and then, basically, you're in a very specific situation that you need to finance a deal. You should probably don't. I mean, that's just honest, just because of the uncertainty. If you're going to finance a deal, your best two asset classes are going to be multifamily and industrial. Those are probably the only two asset classes that you're going to get any real sort of attention to right now, and hopefully some sort of loan commitment for. Within the family space, like we're saying, maybe you can go to some sort of, either expensive bridge private money right now, or, and even that's starting to dry up more and more because just the tools to be able to execute on a deal are becoming harder and harder. But anyone who ever puts out more than 9-10% money somehow always manages to figure out how to do it. But that's always available for multifamily.
Yeah.
And then you have the agencies, which are essentially, again, banks will be very specific, local market to local market. The Fannie and Freddie, where they're lending at, they brought LTVs down to 75%. Fannie, Freddie, HUD are adjusting. I don't want to, it's a longer conversation because each one really is separate. HUD has virtually not changed. It's staying the same LTVs of 80%. Their pricing is really pretty right now. You're talking about, it can go as low as 275 up to 3.25 with all the bells and whistles of what HUD is, the 40-year term with the 40-year amortization. That program has been virtually untouched. The main reason it has been untouched is because it is a very long process program anyways. So I'm working on a particular HUD D4 loan, which is a construction loan. That's been taking 12 months anyways. We were, Corona or not, we were 60 days out. So a lot of the processes are still taking place. So there's just a little slowdown. So that's one. Fannie and Freddie, they put in much more significant restructurings. One being the forbearance, which is on current loans out. So giving 90 days as long as you can show effective COVID on your property. Because of that, they know. By the way, just for the viewers too, people are very confused how forbearance works. Every lender is doing it differently. Fannie and Freddie, are how they're going about it is that your 90 days of payments that you did not pay, you will then be put in a balloon of 90 days of payments and then put over a new 12 months. So after the 90 is done, that group of payments will then be put as a total amount thrown into a new 12-month payment schedule. So your monthly payments will go up significantly, about 10 to 15%, on each paying month after that for the next 12 months. So and that's going to be that delayed recovery, because I think that's where you're going to see a lot of property owners unfortunately fall, who won't be able to do that same capital call.
Won't be able to do that within the 12 months. So that's a good point, actually. So if you're hoping to get a good deal, you're probably going to need to wait a good 12 months for that to actually play out. Whereas prior, as you were saying, 2008, 2009, you'd see it happen a lot sooner. Because
and that's that manufactured delay on recovery that we were speaking about. Exactly. So they have, there's a really interesting note, and again, we can talk for hours, but the forbearance is quite significantly different between Freddie and Fannie. Freddie has a policy where after the 90 days are done, you're able to start to evict tenants and re-tenant them. Fannie, you cannot kick out any tenants for not paying even after the 90 days until your entire forbearance is paid off.
I want to do a separate podcast on this. So I think there's a lot of importance around this, and a lot of people specifically in the multifamily niche looking for guidance on this. I know it's a topic that comes up so regularly. So I'm going to ask you to put a hold on that one. I think we need to do this again and just go through those specific nuances, because
I'll give you some just wrap up words. I heard some two nice things, and just so in sum, over the next couple of weeks, I told you, just not in the fear of being repetitive, we're in a kind of next couple of weeks, after that, and then after that kind of period. I would say between now and April 30th, as far as U.S. real estate and policies, et cetera, as long as the stay in place policies, which is what President Trump's stay inside is called, we will not see any real change. If anything, we'll see more and more lenders start to close, if you will, until that reopens. So either guys will just be telling you, hey, as they've been doing it, show me deals, but we can't. There'll be no formal commitments, unless in very, very radical situation over the next 30 days. So if you have a deal from a broker, if you're circulating a deal, continue to circulate it. If you're having an issue and need to restructure your loan, send it to someone like myself. We'll work through them, have them queued up, and hopefully get them quoted as soon as the gates reopen. And that's really what, God willing, we're looking forward to, really an idea of gates reopening, not that when we reopen it, there's nothing there, right? I mean, no one really thinks that as of now. Of course, there is more extreme school of thoughts and more positive, optimistic school of thoughts. But people think when the gates reopen, there should be plenty of capital there to be provided. The reality is again, between now and then, not many transactions. After that, nobody truly knows. But we have to look at it all step by step. This is the time for everybody to do things that you don't normally get to go to. Continue to educate yourself. Information is king right now. That's the premise of our company here, and that's all we're trying to do all day long, is be able to provide better and better intel and updates for all our clients, partners, so on and so forth. I'll end on this, and just on a kind of a positive side that I heard that was really, really nice, and I really, really like it. First of all, in this, and it can get depressing in your home and this and that, right? There is a concept of, always finding the poetry in life. Personally, I have a 4-month-old daughter. Okay, I'm home and it's crazy, and I have my wife thinking that she is my business partner all of a sudden, and I have her business is the kitchen. That's what I'm not supposed to help with, and and you have all that, and it can get frustrating, and it's a little bit, you go from such a bull market to just mass confusion and slowing down your pipelines and deals not closing and all that. But when you can go outside and say, hey, you know what? In the middle of the day, I'm able just to walk my daughter, around the park for a second. Don't tell the authorities, just for 100 meters from my house or whatever that may be.
Yeah.
That's enjoyable, and that's sort of the poetry in life, and that's what's going to get all of us through that. And then on a more optimistic side, and I'll end on this. It's such a well-stated statement, which is, we have two massive pools of thought right now, schools of thought, right? You have the very optimistic view. 45 days from now, this was all just a crazy blip in our screen. Things will reopen. We'll go back. We're going to go right into a back bull market. It's not even going to be considered a recovery because it's going to be such a tremendous turn on of the lights that, it's like nothing happened, and it'll be a crazy story to talk about. Obviously, you have the other side of the spectrum, the negative school of thought that people don't even know how bad it is. It's only getting worse. We're not being told things from the government that are even more serious. Foundational structures of society are crumbling, and we're going to go back to the Stone Age. And there's guys who think that, and there's even pretty high level people who are thinking that, and it's becoming less and less of a conspiracy. But someone way smarter than me once said that when it comes to the most optimistic, best possible scenario happening, and when it comes to the worst possible scenario happening, those two scenarios have less probability than everything in between. And that's really the truth. I think all that unknown, the only known we have is that whatever people think it may be the worst and the best, it's going to be somewhere in between, because that's just how life works. So I think we have to stick in. It's very important to understand what's going on from today to tomorrow. Personally, we send out a Monday blast and just kind of the updates of each loan product. I'll send it to you, Rikki, today. You can, and stay optimistic.
I get those regularly, by the way, and I actually am posting them up on the website. So I've got your rate sheets on the website and the finance section, so people are welcome to always go have a look at that there. I think on your mailing list, you also send it out on a weekly basis. So if they wanted to, they could reach out to you and get on your mailing list. So where could they get
hold of me? My email is Yair at ponchorealestate.com. Feel free to reach out. Our website is panchofinance.com. There you can see all the contact info and etc. And you can ask our guy Rick. He has my number as well. We try to make ourselves as available as possible. Absolutely. It's the time for, even though we can't physically be interacting with each other, it's better than time. There's no time than now to be able to pick up the phone, have conversations, know what's going on. God be with us all,
Absolutely. Amen to that. I think from my side, the only thing that worries me is how long it's going to be down for, but I'm quite excited personally to have real estate repriced as a whole. I think it's been a hot market for a long time, and I've gotten a lot of my foundational learning throughout the last 5 years. So I'm quite excited to see what we can do over the next 10. Both of us have built a really solid foundation now. You especially got a big business, lots of people working with you. On my side, I'm starting to establish myself a little bit better. So I'm super optimistic. It's just, I think, surviving these next few months that is going to be
key. I was consulting one of my very close friends, but also a very, very successful family. And they have a massive enterprise and a private organization, tens and tens and tens of employees. And he was telling me, I have a much smaller business comparatively to, and I know for a fact they're definitely, they're plenty liquid. They can just stop everything, put it all under their mattress, and them and their generation will be fine. But they're telling me, hey, listen, you should approach all top management, tell them to do at least 25% cut over the next month or two, wherever that be. Fire someone, trim the fat. Don't wait 30 days to see if it's not. The reality is, you have to understand we're in something that is serious. It's scary, but don't be scared of it. You just have to sort of work through it. And there'll always be light. It's just what you said. The key word is surviving it. It sounds dramatic, but it is what it is. And be resourceful. This is not the time to necessarily put massive money into extra things that you were planning on doing it. But at the same time, run your operation. Don't sit on the couch and wait it out, because then you will be left in the dust. But if you put maximum effort, you keep probing the market, keep trying to update yourself, and be smart during these challenging times. we'll all be better for it, on the way.
It's like the saying goes, a coward dies 1,000 deaths. So just playing to the fact that you keep imagining the worst case, and you're experiencing it in your mind. And the reality is it's the least probable outcome is the worst case, or at least one of the least probable. So it's best not to run through that. It's best to stay optimistic, to make provision, to think strategically, and to just give it your all and ride it out. For most of us, fortunately, it's going to mean less eating out, less coffee, a downgrade in a car, and a downgrade in a lifestyle. There's many people in way worse
at least we
situations.
save on gas. That's what I always say.
That's it. Yeah. For sure. Great. Anyways, I'm going to close off on that because we could just keep going, and this is already turning into a long episode. Thank you so much for your time. Thanks for being online, and we hope to have you again. I'd like to just run through specifically again on COVID-19, some of the technicalities regarding forbearance on the different loan programs, and we can look forward to hearing that from you soon. So without further ado, cheers, Yair. Thanks you for being online and for joining us. And just like that, ladies and gents, we've concluded another episode of the Creative Real Estate Podcast. If we've brought any value to you, please go ahead and share the podcast or subscribe to all our other social platforms for additional content. From me to you, thank you for your time, and remember to stay curious and keep it creative.